You know, the biggest story in crypto lately isn't some hot new coin. Nope, it's about who's buying the OG? Corporations. I mean, what started as a kind of fringe experiment for cypherpunks has totally gone mainstream and become a corporate strategy. But the real question is this a boom for Bitcoin or a potential bust? Let's get into it. Okay, to get a sense of just how massive this trend is, just look at this number. 855,000. That's how much Bitcoin corporations are holding as of mid-2025. That's nearly 4% of all the Bitcoin that will ever exist. It's a truly staggering figure, and it proves just how deep corporate money runs in this space now. So how did we even get here? I mean, it really all started with the few bold, almost kind of crazy experiments. But now holding Bitcoin is seen by a lot of people as a legitimate mainstream financial strategy. Let's take a look at the new corporate players who completely changed the game. And you can see the results of that shift right here. What was once a niche interest for a handful of idealists has just ballooned into a corporate movement worth nearly $80 billion. This isn't just another trend. We're talking about a fundamental change to the entire crypto landscape. And it's being driven by some of the biggest names in business. So why are they all buying? What's the big draw? Well, let's explore the bull case. We're going to unpack the powerful arguments for this corporate takeover and see why so many companies now look at Bitcoin as a mainstream asset they just can't afford to ignore. Their thinking usually boils down to 4 key advantages. First, there's the massive legitimacy boost. You know, when a major company buys in, it sends a signal of credibility to the entire market. Second, it can act as an inflation hedge, which is a big deal in an era of devaluing currencies. Third, of course, is the raw financial upside from the price just going up. And finally, you can't ignore the branding power. Holding Bitcoin makes a company look innovative, like instantly. And that legitimacy point is absolutely crucial. The whole narrative has shifted away from, magic internet money. Now, like this says, it's being treated as a serious strategic asset by major players. That change in perception is huge. It's what's pulling in even more institutional cash and helping create deeper, more stable markets. Now check this out, because this is where the financial upside gets really wild. In 2023, Bitcoin had an incredible run, right? Up about 150%. But look at MicroStrategy's stock. It rocketed up over 350%. So why the huge difference? Well, it's because investors started treating their stock as a sort of leveraged bet on Bitcoin itself. Their crazy aggressive buying strategy didn't just pad their balance sheet, it completely transformed their entire identity on the market. But of course, it's not all upside. You knew this was coming. For every bull argument, there's a bear lurking right around the corner. So now we're going to pivot to the bear case and unpack the very real, very significant risks that pop up when corporate boardrooms get control of this much Bitcoin. And the first risk is the most obvious one, the brutal, gut-wrenching volatility. Just look at 2022. The price crashed from a peak of nearly $70,000 all the way down to $16,000. For you or me, that's painful. For a public company's balance sheet, that kind of drop can be absolutely catastrophic. And this isn't just a theory. This is the exact reason Tesla sold off 75% of its holdings, citing liquidity concerns. And volatility is really just the start. The risks here are layered. They run from custodial centralization, which is the whole who actually holds the keys problem, to a regulatory landscape that's constantly shifting under our feet. Then you add in reputational headaches from ESG concerns, and you have the perfect recipe for the most dangerous risk of all, a market-crashing cascade of corporate sell-offs. This brings us right to that custody question. Who's holding the keys? You might think these giant corporations are all masters of self-custody, but nope. Most of them rely on third parties, with a massive 30% chunk managed by Coinbase alone. This kind of concentration creates enormous single points of failure. An issue at just one custodian could send shockwaves through the entire system. And this gets us to the risk of so-called fair-weather allies. Just imagine a bear market really kicks in, and a few of these companies decide to cut their losses and run. A coordinated sell-off of just 100,000 Bitcoin, which is totally plausible, could tank the price by another 15 to 25%. We saw a tiny version of this when Tesla sold, But with dozens of companies now holding huge sums, the potential for a domino effect is way, way bigger. Okay, so we've got the powerful bull case and the pretty sobering bear case, but the reality isn't that black and white. To really get what's going on, we have to look deeper. Why? Because not all corporate adopters are created equal. It's time to separate the true believers from the simple marketers. Think of this table as your cheat sheet for figuring out the corporate crypto world. On one end, you've got your tech-forward believers, like MicroStrategy, making these huge, high-conviction bets. You have crypto natives like Mara, where Bitcoin literally is their business. And you have inflation hedgers like Mercado Libre, just trying to preserve value. But then, on the other end, you have the marketing-driven adopters. Think GameStop or Rumble, where the purchase feels more like a PR play. These are the fair weather friends who are most likely to sell when the going gets tough. And that is the key takeaway here. The next time you see a headline about some company buying Bitcoin, you'll have the framework to ask the right questions. Is this a real long-term strategic move, or is it just about short-term hype? Trust me, understanding that difference is everything. So where does that all leave us? Let's bring it all together for the final verdict. What we're looking at is a fragile alliance, and we have to balance the powerful upside with some equally undeniable risks. So what have we really learned? 1. Corporate adoption brings a huge legitimacy boost and adds deep liquidity to the market. 2. At the same time, the risks from volatility, custody, and regulation are very, very real. 3. We've seen that the most committed holders are those tech-forward and crypto-native firms. 4. The hype-driven adopters are the ones who pose a real risk during a downturn. It all leads to this paradox. This trend is making Bitcoin both stronger and somehow more fragile at the same time. And that brings us to the central tension of this whole story. And it leaves us with one last big question. As this corporate takeover keeps evolving, is it going to prove to be Bitcoin's greatest strength, or will it be its Achilles heel? Right now, the answer is still being written.